we're looking at the motives for holding money. Motives for holding money. Now, let's first look at the definition of money. Money is anything that is generally accepted as a medium of exchange and for settlement of debt. And for this particular topic, we'll be looking at demand for money. Why do you demand for money? Why do you hold money? And under it, we have what we call liquidity preference. The demand for money refers to the total amount of money which an individual wishes to hold in liquid form rather than spending or investing it. In economics, this desire is formally known as liquidity preference. So what it means is that liquidity preference also means demand for money. It has to do with the total amount of money you wish to hold in liquid form. Liquid form here means raw cash. Raw cash. When you decide to hold 10,000 naira cash instead of paying it into a bank account. So that's the meaning of liquidity preference. And we also have the core concept. It is essentially the preference of economic agents to keep their resources in most liquid form to facilitate immediate transactions, security, and balancing the cost of low interest income. So what happens is that as individuals, we just feel like keeping our money in liquid form, in raw cash, to just in order for us to facilitate immediate transaction. For example, someone like you may decide, or your mom may decide to just have 10,000 with her, or to have cash with her, so that she can buy goods from hawkers or anybody on the street, or just keep it, for eventually there's someone that is not feeling fine later in the day, or she needs to buy something, on a rush. That's, liquidity preference. Then we now have, according to Law Maynard Keynes, we have three motives for holding money, for holding cash. Three motives for holding cash. And number one motive is for transaction, and it's known as transactionary motive of holding cash. Holding cash for day-to-day transactions and current expenditures to bridge the gap between income receipts. What this one means is that you hold cash most times for transaction. You just feel like, okay, I need to have this cash with me to, buy something. I need to, keep money with me to buy something while on a journey. I should just have cash with me. Then we have precautionary. You keep money most times for unexpected events. So keeping money aside for unforeseen contingencies or unexpected events is one of the motives for holding money for the precautionary motive. When you keep money for emergency, medical situation, or accidents, or emergency fund for school fees, for anything that can come, in an unforeseen event. We now have the third motive for holding money, which is speculative. Speculative motive for holding money has to do with when you embark on business dealings in the bond market and taking advantage of interest rate fluctuation. That is when you feel like a particular company, you like a particular company, and you feel you want to invest in that company and buy the shares of the company. That's one of the motive of holding money, and that falls under speculative motive for holding cash or holding money with you. Then we now have some basic features of transactionary and precautionary motive of holding money. Number one, it's transactionary motive of holding money. It's vital for household consumption and business operations. As an household, as a family, most times we need to have raw cash with us to buy things buy things that we consume. Mommy can decide to keep some cash amount with her to buy pepper from the market or buy pap in the morning. Then business operations, company can decide to hold cash with them to buy petrol for daily usage, pay daily newspaper vendors that come to supply them newspapers on a daily basis. Then for under precautionary, it serves as a safety net, acts as an insurance against rainy day scenarios. There are some days that may be very, very rainy, that is a bit bad. For example, a particular staff, a particular father or mother falls sick. So the person actually needs to have a kind of fund to, stay balanced once that kind of situation. Transactionary motive for holding money is for transactions for your daily spending, while precautionary it serves as a safety net. A safety tool, a way out once there's an emergency. Now we have the speculative motive. The speculative motive has an inverse relationship with interest rate. That is, the speculative motive is primarily driven by expectations of changes in security markets. When interest rates are low, people expect them to rise and thus more cash and hold more cash. So basically, it's about when you look at it's more about looking at, let me use this form of scenario, shares of a particular company. When it's low, you buy it. When it's high, you feel like, wow, it's time for you to make your money, you sell it. So that's basically what speculative motive of holding money entails. When you when you hold money for investment mainly. Then we have the supply of money. Supply of money has to do with the total stock of money available for use in an economy at a specific time. This includes currency, that is notes and coins in circulation, and bank deposits in current accounts. So the total amount of money, total stock, total quantity of money in an economy, at a particular time, let's say in a year, that's supply of money. So supply of money means the total stock quantity of money available for use in an economy. It can be the currency in circulation like coins or notes in circulation, and bank deposits in current accounts. Then the regulatory oversight is typically managed by the central bank to ensure price stability. The regulatory oversight is typically managed by the central bank. And while I was teaching this particular topic last week, I asked my students, why we don't see or use coins in Nigeria again. And the reason is basically because of the inflation rates. You can hardly buy any product with in coins, like 10 kobo, or in the olden days when they used to have kobo, So now, because of the inflation rates, many parts of our currencies is more of outdated. For example, you can't spend 5 naira because of the inflation rate, and that leads us to the value of money. But before we go into that, let's look at factors affecting money supply. We have the bank rate. When you talk of bank rate, it has to do with a deliberate attempt by the central bank to regulate the lending pattern of commercial banks. So the central bank always charges commercial banks or increase the interest rate to lower, the lending ratio or lending rate of commercial banks. What this actually means is that if the central bank wants the commercial banks to, loan out more funds, there's a way they reduce interest rates. But if they want them to keep money more out of circulation, they will increase interest rates. So bank rates, the interest rates of bank rates is actually the interest rate the central bank charges commercial banks for loans. So most times it's we have monetary. It's also called monetary policy rate. And currently in Nigeria is 26.7%. So you can read more about that. Then we also have cash reserve ratio. These are factors that affect money supply or the money circulation. The percentage of deposits bank must keep with the central bank. All the money deposited in the commercial banks are not disbursed into circulation. There are some parts that are kept with the central bank, and that's known as the cash reserve ratio. And the current cash reserve ratio is 46%. Yes, you can also check that on your own. You can also check, but I'm trying to, because I just read through it now. Let me check, maybe I will be able to see it. I'm coming. Let me check, maybe I'll be able to see it. But you can read that on your own. You can read that on your own. You can read that on your own. So cash reserve ratio has to do with the amount of money or percentage of deposits bank must keep with the central bank. That is, commercial banks must keep with the central bank. Then we also have the economic state. Central banks reduce supply during inflation. Inflation basically means excess money pursuing too few goods. So when there's excess money in circulation, after some time, it just lead to increase in general price level, and prices will just so high. So central banks reduces supply of money during inflation, and they increase it during deflation. So you are still going to look at those topics. This is just a picture of a graph of monetary policy cycle. Then we also have the quantity theory of money, which was provided by Sir Irving Fisher. The theory posits talks about the fact that the value of money depends on its quantity in circulation. That the value of money depends on the quantity in circulation. Fisher concluded that the price level varies directly with the quantity of money, assuming velocity and transaction volume. Assuming velocity and transaction volume remain constant. So the theory just talks about the fact that the value of money depends on the quantity in circulation. That if a particular money has value, it depends on the quantity of it in circulation. Then there's a formula for that. It says MV is equals to PT. MV is equals to PT. That is stock of money. MV has to do with stock of money in circulation. V is velocity of money, that is the speed of change. Then P is average price level, that is the total volume. Then T is the total volume of transaction. T is the total volume of transaction. So MV is equal to PT. Then when you look about value of money has to do with the purchasing power that a particular currency has. So that is an increase in price level, like inflation, leads to a proportional decrease in the value of money. When you talk of value of money, it has to do with the quantity of goods a particular money or currency can buy. For example, now if you are giving 100 naira in Nigeria, you can buy 3 sachets of pure water. But if somebody should give you 100 pounds, that's 200,000. So that invariably that means that the value of pounds is higher than naira. So with 100 pounds is 200,000 naira. But 100 naira can just buy 3 sachets of water. So with 200,000, you can buy, divided by 400 naira per bag. If you divide the 200,000 divided by 400, that's almost like 500 or how many? Yes, 500 bags of pure water. 500 or 5 times. You can check the calculation on your own. So that tells you about the value of money. So value of money increases when you can use a little amount of money to buy many goods. While on the other hand, value of money reduces when you have to spend more to buy more. So for example, now if I take 10,000 to the market, I can just buy a few things. Let's say 5 or 6 things. That means the value of money is not high. But if I take 10,000 to the market and I can buy so many things and still come back home with change with me and everything, that means the value of currency is high. So I don't know, maybe you have any question. If you have any question, it will be sorted out in the class. You can go through this particular video again, So in summary, what I've treated has been value of money, which has to do with the purchasing power of the currency, if a currency. Then we also looked at the quantity theory of money proposed by Sir Irving Fisher, which talks about that the value of money depends on the quantity in circulation. Then we also looked at factors affecting supply of money, that is the bank rate, that is the interest rate that central bank charges commercial banks for loan. We have the cash reserve ratio, that the percentage of more deposits that is being kept with the central bank is mandatory in order to control the supply of money in circulation. Then we also have the economic state of the country. If there's inflation, the central bank will reduce supply of money in circulation. Then we also have supply of money in terms of the definition, you know, and we also need to understand that it's the supply of money deals with the total stock of money available for use in an economy, and it comprises of the currency in naira, in notes and coins, and also bank deposits in current accounts. We looked at speculative, the motives for holding money. We have the transactionary, precautionary, and speculative. Transactionary is for daily usage, when you hold money or raw cash for buying of things daily. Speculative is when you hold money for unforeseen events. Speculative is when you hold money for investment. When you look at the shares of a particular company and feel like this company has prospects and I feel, let me invest in it. So that will be all for now. So the week one topic for SS2 third term is money, and it has to do with the motives of holding money. So very soon the week two topic will be out too. The week two video will be out. So stay tuned. My name is Mr. Olatunji, and I'm here to just give you a breakdown of week one topic. So take care.